Good morning, Miss. My name is Prislamo Sinsian from class DAC 2A. Matrix number is 20 DAC 25 F1067. I will be explaining the nature of provision, contingent liabilities, and contingent assets. First, let's look at the nature of provision. A provision is a type of liability that involves uncertainty regarding its timing or amount. However, even with this uncertainty, the obligation is still considered present obligation arising from a past event. Therefore, it must be recognized in the financial statements. There are three conditions for recognizing a provision. First, there must be a present obligation from a past event. Second, it must probable that an outflow of economic resources will be required. Third, the amount must be estimated reliably. For example, warranties are a common provision. When a company sells product with a warranty, it is expected to repair or replace defective goods. Although the exact cost is unknown, it can be estimated based on past experience. Another example is litigation. If a company is likely to lose a lawsuit, it must estimate the compensation and record it as a provision. Refunds are also provisions, as companies must estimate the cost of returned goods. Next is the nature of contingent liabilities. A contingent liability is not recognized in the financial statements but is disclosed in the notes. It arises when there is uncertainty about whether an obligation exists or whether payment will be required. There are two types of contingent liabilities. The first is a possible obligation, where the obligation depends on uncertain future events that are not within the company's control. The second is a present obligation that is not recognized, because the probability of payment is low, or the amount cannot be estimated reliably. A good example is a legal dispute. If a company is involved in a lawsuit but it is unclear whether it will lose, then it is treated as a contingent liability. Another example is a loan guarantee, where the company will only have to pay if the customer fails to repay. Last is the nature of contingent asset. A contingent asset is a possible asset that arises from past events, but its existence depends on uncertain future outcomes. For example, a company may file a lawsuit to claim compensation. However, since the final decision depends on the court, the asset cannot be recognized immediately. If the inflow of economic benefits is probable, the contingent asset is disclosed in the notes. It is only recognized as an asset when the inflow becomes virtually certain.
My name is Gracie Alicia Anak Rolinjek. My matrix number is 20 DAC 25 F1045. Nature of contingent asset. For example, OGC builder Sendirian Berhad is taking legal action against Amok Berhad for failing to deliver on contract for its product. The lawsuit is in the final appeal. The legal advice is that it is probable that they will win the case and will be awarded 400,000 ringgit. Can OGC builder Berhad recognize this item as an asset? The answer is this is a contingent asset. The contingent asset cannot be recognized as an asset, even though the gain is probable and reliable estimate. The gain should only be recognized when it is certain or visually certain. It is disclosed, but care should be taken to avoid misleading information regarding the likelihood of the gain. Recognition of provisions. A. Present obligation. A legal or constructive obligation exists due to a past event. B. Probable outflow. It is more likely than not, below 50% probability, that resources will be required to settle the obligation. C. Reliable estimate. The amount of the obligation can be measured with sufficient reliability. For example, an employee at OGC Builder Sendirian Berhad has suffered a serious injury while operating laboratory equipment at one of the entity's outlets. The employee has filed a lawsuit against OGC Builder Sendirian Berhad. Based on the evidence of the case, lawyers for OGC Builder Sendirian Berhad believe that they will not lose the case. Is there a probable future outflow of resources? The answer is OGC Builder Sendirian Berhad has a present obligation. The injury occurred at its outlet, arising from a past event the injury led to the filing of the lawsuit. However, the future outflow of the resources is not probable because the lawyers believe that the entity will not lose the case. Therefore, there is no provision to be recognized by OGC Builder Sdn Bhd. Measurement of provision. Best estimate. A provision is measured at the best estimate of the expenditure required to settle the present obligation at the reporting date. This means the amount should reflect what the entity realistically expects to pay. Risk and uncertainty consideration. The measurement includes uncertainty and risk surrounding the obligation. This ensures the provision reflects real world condition, not just a fixed number. Judgment based on available information. The estimate is based on management judgment using available evidence and past experience. It is not a guess, but the most reliable figure supported by information. Discounting time value of money. If the effect of time is material, the provision is discounted to present value. This means future payments are adjusted to reflect today's value.
Hi, my name is Felicia Gantana Solang. My matrix number is 20 DSC 25F 1021. I'm from DSC 2A. Recognition and disclosure of contingent liabilities. A. Non-recognition policy. Contingent liability are off balance sheet. They are never recorded as liability in the statement of financial position. B. The disclosure rules require when the outflow is of benefit is possible 5% and to 50%. As an example, when the risk of outflow is removed under 5%. Required information is not. Brief description of the nature of the obligation. Estimate of its financial impact. And last, explanation of the uncertainties involved. The disclosure should include the nature of the contingent asset. An estimate of financial effect can be measured reliable. This ensures users are informed without compromising prudence and reliability. Once the flow of economic benefits becomes virtually curtailed, the item is no longer treated as a contingent asset. At this stage, it is recognized as a normal asset in the financial statement. This treatment ensures that only confirmed economic benefits are recognized as assets. First, statement of financial position, balance sheet. Provisions are present as liability. They must be split into current liability, expected to be settled within 12 months, and non-current liability settled after 12 months. Next, statement or profit or loss. The expenses related to the provision is recognized here. If the provision is measured at present value, the unwinding of the discount, the increase in the provision due to the passage of time is recognized as a financial cost. For example, in 2023, OGC Builder Sdn Bhd has a provision for repay of 90,000 ringgit, which is expected to be settled within 12 months from the reporting dates. At the same time, OGC Builder has a provision for litigation of 900,000 ringgit, which is expected to be settled in 3 years' time. The financial year end is 31st December 2023. These provisions are present as follows. Statement of profit or loss for the year ended 31st December 2023. Expenses amount 990,000 ringgit. Statement of financial position as at 31st December 2023. Non-current liability. Provision for litigation 900,000 ringgit. Current liability. Provision for repay 90,000 ringgit.
My name is Rachel Dia Anna Helen Harrison. My matrix number is 20DSC25F1057. Now I will start with the disclosure requirement for provision in the extracted financial statement. For each class of provision, the entity must show several key movements. First, the carrying amount at the start of the period. Second, any additional provision made, including increases to existing ones. Third, the amount utilized, which are the costs actually incurred and charged against the provision. Fourth, any unused amounts reversed when the obligation is no longer probable or costs are lower than expected. And finally, the increase in present value, also known as the unwinding of the discount. Third is reimbursement, the amount of any anticipated reimbursement and whether any asset has been recognized for it. Moving on to the presentation and disclosure requirement for contingent liabilities. Regarding presentation, we follow the off-balance sheet rule. For contingent liabilities, no amount is recorded in the statement of financial position as they do not affect total liabilities or profit for the period. The reasoning follows the prudence principle, which ensures that financial statements do not include maybe asset or uncertain that could mislead investors. Regarding disclosure, unless the possibility of an outflow is remote, meaningless less than 5%, an entity must disclose a brief narrative for each class. Or contingent liability at the end of the reporting period, the notes must include the nature of the obligation, such as a legal claim for a former employee, an estimate of financial effect, showing the potential dollar amount measured using the same principle as a provision, uncertainties, indicating the factor that will determine the final outcome, like a pending court verdict, and reimbursement, noting the possibility of any recovery from a third party, such as an insurance payout. Finally, let's look at contingent asset. Similar to liabilities, these follow the off-balance sheet rule. No amount is recorded, and they do not affect total asset or income. Again, these follow the prudence principle to avoid misleading investor with a maybe asset. However, the disclosure rules for assets are much stricter. You only disclose them when an inflow of economic benefit is probable, which is defined as greater than 50%. What must be included in the notes are the nature of the asset. For example, a bonding insurance claim for fire damage. For the financial impact, which is an estimate of the financial effect, provided it can be measured without being misleading. And a final note, it is important to avoid giving a misleading impression of the likelihood of the income arising.
Hi, my name is Trisha Latani and my registration number is 20DAC25F1071. Question 1. OGC Builder SDN PhD is currently facing a legal dispute with a subcontractor regarding a side project. The company's legal advisor has assessed the case and concluded that there is a 35% chance that the company will lose and be required to pay damages of 60,000 ringgit. How should OGC Builder SDN PhD report this situation in its financial statement? The answer is OGC Builder SDN PhD should disclose this situation as a contingent liability in the notes to the financial statements rather than recognizing it as a provision in the statement of financial position. Under MFRS 137, a provision is only recognized when the outflow of resources is probable, meaning a more than 50% chance of occurring. Since the legal advisor assessed the chance of losing at only 35%, the obligation is classified as possible but not probable. Therefore, the standard requires a narration disclosure in the notes to perform uses instead of recording a liability on the balance sheet, ensuring the company adheres to the prudence principle by not prematurely recording uncertain debts. In conclusion, MFRS 137 ensures financial transparency by distinguishing between recognized provision and disclosed contingency. This approach upholds the prudence principle, ensuring that financial statements reflect realistic obligations without recording uncertain gain or losses. By applying these standards, a company provides a more accurate and reliable view of its financial health to all stakeholders.